Welcome to TheoTrade. This is Don Kaufman. You are watching the weekend edition of the Theo video for February 20th, 2016. Let's get started with a quick kind of week in review and then move right forward into what we could kind of expect this coming week. First and foremost, the S&Ps in yesterday's trade. I think yesterday, which was, of course, Friday, February 19th, it's one of the first days in quite some time. It was a little bit boring out there. Volume, volatility, it just wasn't necessarily there, which may or may not be considered a decent thing. But let's actually look into it. So throughout the course of this past week, we saw an explosive rally to the upside. Now, that has all the hallmarks of what they kind of call the quintessential rip your face off rally that you expect in the midst of heavier volatility. Now, whether you know that or not, again, big explosive rallies are simply part of the volatility process. Now, we drew a couple of lines. I'm not a huge market technician, but a couple of trend lines on the chart over here quite some time ago. We're actually, we've had these up here just since about mid-January. These were drawn, and some just really key kind of inflection points in the market, one of those being in the S&P futures. And again, these relate to the S&P futures 1911. Okay, lower down below 1871, and how long we've actually remained inside that range. Now, we closed above it on Friday. Now, being above it doesn't necessarily draw a line and say, no, it's bullish for right now. Not at all. Simply these levels, okay, are where the markets have been migrating to now, again, for a period of just about, 5 to 6 weeks. We're actually seeing markets in and around this range. We've seen heavy volume trade at 1871 with the S&P futures, heavy volume trade, and again, 1911. Now, if you think I'm focusing a lot on the futures lately, there's a reason for it, okay? In the midst of volatility, the stocks in the S&P 500, and that's why I'm looking at the S&P 500 futures here, but the stocks in the S&P 500 in the midst of volatility typically have a correlation north of 85%. That ultimately means whatever the S&Ps do, okay, and the S&P futures do, 85% of the stocks in the S&P 500 will do the same. In the midst of extreme volatility, the correlation coefficient actually rises to above 90%. In fact, in the bottoming process, okay, that's been seen in previous heavy areas of volatility in the markets. And you can go back, again, in numerous years in terms of in the midst of volatility, correlations rise as high as like 92, even 93%, all right, which ultimately means it's not about individual stocks. Again, it's about the broader market. So we get this explosive rally this week, and it allows us as traders and predominantly as premium sellers to close a number of positions. Number one position I'll briefly talk about. Again, this isn't an equity product. We closed a bullish position inside of Amazon. And again, I like to sometimes recap just a few of the positions we had on, what we took off, and so forth to kind of, you could reconcile with these. It was only in the previous week we actually purchased a 500-505 call spread, okay, in Amazon. We went ahead and closed it. Decent profitability, okay. We were about 50 to 60% profitability on there, so we went ahead and closed it. Again, we were looking for the bounce trade. We got it. Another one that we went out ahead and closed out of, EEM. EEM, we actually sold a put spread. Again, in the midst of some fairly extreme volatility, the implied volatility was so elevated inside the EEM, it was a nice opportunity to be able to sell an out-of-the-money put spread. Went ahead and closed it. Again, that was upwards of 60% profitability in the EEM. Next one on my list over here, XLE, the energy sector. Now, the XLE, that's an underlying where I wouldn't mind owning the XLE. Okay, not necessarily at this 56 level, but I've been out there selling puts, okay, naked. And the reason I'm selling naked is because I quite literally want to get put the XLE, and I'm willing to turn around and buy the shares. And then after I buy the shares, I'll sell premium against it, okay, in something similar, not exactly, but similar to covered calls, okay. For those of you that didn't necessarily want to by the XLE. Many of you sold a put spread. That put spread would have been closed. Why? Because once again, we had this rip your face off rally, which is something we expected in the midst of volatility. So we have this explosive rally. We cover the put spread again. It was right around a 60% profitability over there. Last but not least, on some of the trades, and again, you always want to kind of reconcile your trades at the end of the week. It's more important than dissecting like what happened in the market this past week. Doesn't matter. Only thing that matters is what kind of risk do you have on and what risk did you take off. Another trade that we actually took off, an iron condor. Now this is an iron condor that we put back on, okay? So the iron was originally sold all the way back here, and I want to zoom in to this a bit. So we went out and we initially had sold the iron condor right in this neighborhood here, okay? So the actual iron condor was placed on, all right, January 6th, and we initially sold the iron condor, and the reason I like to mention this, we had sold this way out of the money iron condor, and it was a $10 wide iron in the SPX. Okay, and we sold it for right around $2.20. All right, and that was again $2.20 credit. Now, I was able to actually buy it back this week, and I bought it back for $1.55. All right, so if you do the math really quick, like, did you make a couple of cents on it? Yes. But, you know, transaction costs and everything, it doesn't matter. It was profitable in the midst of some of the most extreme volatility we've seen any time since like 2011, 2012. So at times, you got to step back and realize, okay, not taking a huge loss is a ginormous, if you will, win. And I like to point out trades that sometimes don't necessarily go our way. Now, this is when we sold. Again, we sold it for $2.20. We bought it back for $1.55. So, yeah, you know, you made a couple of cents on it here. All said and done, maybe you made 50 cents after transaction cost. Doesn't matter because you weathered the storm of this kind of move, all right? And one of our strikes in the iron condor, we were literally short, okay? The 1,800 puts down here. If you traded the thing right, you traded at the right size, you held the trade, market bounces back up, volatility gets sucked out, we close the trade, okay? And that's, again, that's what selling premium is all about. It's being capable of being able to weather the storm out there. Now, before I go into any details about what I think is going to go on this next week, and we're going to look at that here momentarily, one thing I do want to recap for all of you here at TheoTrade, we've actually got the classes archived, and I wanted to go over this because we've had a tremendous number of emails, and then we're going to jump directly into really what I'm seeing in the markets kind of moving forward here. Surviving the extreme volatility, our first class, our second class, of course, it's all archived now under the member, again, under archives. We've got the member chat room archive, the coaching sessions archive, the classes archive, and I wanted to show this. It's the Sell Premium and Manage Risk. This was last Saturday's class, okay? And what we actually did is broke it into separate chapters over here, so an hour and 25 minutes, an hour. The entire slide deck is available right over here on the right-hand side of the screen. Okay, I also did kind of a follow-up session. Okay, and that follow-up session was this Wednesday evening session, and it was about volatility bombs and calendar spreads. So I went ahead and we archived that both in the classes section. That can also be found in the coaching sessions as well. So again, realize if I have a slide deck, I will absolutely put a PDF version of that slide deck here. So if you're curious about the coaching archive, and the reason I'm bringing up the coaching archive is we did a couple of coaching sessions this week pertaining to the class from last weekend. Obviously, calendar spreads, volatility bombs, the Greeks putting it all together there, a little bit of Q&A from Friday. This is also the session, the beta weighting session, which I think really ties things together a lot. That is from the archive from February 18th, beta weighting. I think it's a critically important session, as well as Vega, which is your exposure to volatility. So again, all of you that are members, check out the archives in there and just kind of cruise through. Again, the class is posted. You can't go wrong. It's archived and it's in there, forever for you. Now, looking to the week ahead, one of the first things I noticed in the week ahead, forget about like looking at the chart right now. I mean, I legitimately mean forget about looking at a chart, okay? The market, okay, undoubtedly is at a huge inflection point. We're at a crossroads right now. This is actually what happens a lot in volatility, okay? If you're into like, you know, the doji over here, you're like, oh, this is actually a bearish, like looking like, you know, candle over there. But I'm not into that stuff at all, because right here, right now, you know, we talked about this big inflection point of 1911 in the S&Ps. Come on, we closed there on a Friday afternoon. The markets couldn't be any more indecisive than they currently are. There's a few things, though, that for me as a trader really present very serious concerns. And my concerns are not bullish ones right now. And I've actually re-upped a bit of a short position. I'm going to show you exactly why. I saw the rip your face off rally. And again, that's what everybody in the market has called it for like decades when these big rallies happen. I saw the market explode, but I didn't see the bonds fall off. Okay. Yeah, the bonds, they backed off a little bit. Okay. The bonds are not backing off. That basically means, okay, in no uncertain terms, traders, okay, listen, okay, this is really simple. The bonds are to the moon over here. We're threatening, okay, the 166, kind of 167 level inside of the 30-year, you know, bond futures. This is duck and cover kind of territory. Thinking anything less than that, I think you're kind of fooling yourself. Now, the bonds alone don't necessarily do it for me. So I go over to the notes. And, well, yeah, I mean, come on. The notes are going to show almost the exact same thing. The only difference between the bonds and the notes, this one's a 10-year, this one's a 30-year, yada, yada, yada. Let's go to gold. I don't often bring up gold, okay? And it's because it's not a product that's kind of been on the forefront of moves lately, okay? But gold at these levels, you better believe it makes me nervous. And gold has got this just wicked consolidation pattern. Again, I'm not a big market technician, but you can see, all right, how quickly this wedge just formed over here, which means gold is going to probably make a very explosive move. Unfortunately, you don't see that necessarily. Again, this consolidation pattern, you don't necessarily see that inside of the bond market. What concerns me about gold, it too is displaying tremendous risk is imminent in the market. Bonds are displaying risk is imminent in the market. Okay, oil got whacked back down by $1, but oil at this point, you know, they're just waiting for everybody to throw in the towel. Okay, I mean, really, it just looks like, you know, traders throwing in the towel in oil, and I don't necessarily think that there's a tremendous, you know, downside potential in oil. Make no two ways about it, though. The mid-20s, I do believe, once again, is possible in oil, and I'll show you exactly why. If you look at just the 30-day, 25-day options, I should say, in this case, in oil, they have a $5 expected move. Okay, so that actually takes oil just on a normal basis. The normal expected move is $5. We're trading at about 32. Right there, it says oil could move easily down to 27. So you just have to keep that in the back of your mind, and that's a normal kind of move over there. Back over to the SPX, one thing that does stand out to me in the SPX, and this is the first week in quite some time that I've discussed this, but in the SPX, we're now seeing the lowest expected move that we've seen, okay, since the beginning of the year. So if you look at the week ahead over here, 6 days kind of remaining, the expected move is only about $37. It's actually really, really low in comparison to where it has been. And sometimes it just, you know, it pays to do just a little bit of homework. So what I've done is I've just gone over to the Thinkorswim Analyze tab. I went to Think Back. Okay. All it does is just records end of day data. And we'll just show you what did last week look like. Last week, okay, only had, you know, 4 trading days. And it didn't even really have 4 trading days because Monday last week was a holiday. Okay, so in the shortened week, and with the expiration of SPX on Thursday night, it was still showing a $43 move. Okay, go back to the week prior. The week prior, let's go back over here to the 7th. All right, so when I jump to the 7th, I look at the 5-day options in there, then almost a $50 expected move. Almost a $50 move. You realize, like right now, we're only seeing like a $37 move. Okay, on a percentage basis, these are very large differentiations of expectations of risk. We'll go back even one more week. One more week. What do we see back another week? Look at the 5-day options. All right, once again, about a $40 expected move. That's the second to the lowest, but go back again even a week, and now we're in the midst of some more extreme volatility. Again, you have to be very, very aware. The volatility, okay, this week coming into it is low. What it tells me as a trader, I do not want to sell premium, okay, come like Monday morning. I'm not going to be thrilled about it, especially in the index products, because the volatility is inherently much lower than it has been at any other point. All right, in the last, well, again, since the beginning of the year, that's kind of the lowest volatility we've seen, all right, for what, the next 5 days. Okay, so I'm not going to run out there and sell really, really short duration premium because I don't want to walk myself right into a wall. And that means volatility very likely this week could expand outward. And that's something I'm going to be looking for. The next thing I look at, I've been looking at the XLF. All right, day in and day out, I've been watching the volatility. Now, for the first time, okay, in a while, we've actually seen the XLF drop out of what's called backwardation. We dropped back into a contango. What that ultimately means, short duration volatility is now below the longer duration volatility. Just want you to see 13 days out over here, that volatility is fairly extreme. Obviously, because there's a large announcement coming out that week that's going to impact the entire financial sector. Nevertheless, we're still sitting at a 27% volatility through and through inside of the financials. Okay, why is that, important? Because the volatility in the entire S&P is only sitting, well, here's the VIX, at about 20. Okay, so these are things to think about, and you're like, well, what are you kind of saying? I'm saying the financials have been leading markets around by the nose lately. They're still displaying considerably higher volatility than the rest of the S&P 500. I mean, it's ironic to think that the financials right now, again, they're displaying more risk, okay, than the Nasdaq is. I mean, when you think about that, it almost doesn't even make sense when you're looking at a stock like Google. Google couldn't be a better stock. Google has a 27% volatility 13 days from now. Google. The XLF, the entire financial sector, actually has a higher implied volatility than does Google. All right? Could Google have a bad report come out? Not earnings, it's already through earnings, but an announcement? Absolutely. The XLF is a compilation, again, of all your financials, and yet they still hold a higher volatility. The market right now is absolutely scared of the future of risk to the financials. Okay, and it's something we're going to keep our eyes on. I'll also go over to the EEM, which is emerging markets. The EEM also, okay, has just held on to a much heavier implied volatility than has many of the other major ETFs and sectors. And that's because the EEM, emerging markets, have a tremendous exposure to any changes in interest rates over here. So that is where my eyes are focused throughout the course of the week. In terms of major announcements, you always want to cruise throughout the course of a week and be like, what announcements do we have? Okay, if we come to Wednesday, by the way, Wednesday, there's a petroleum report. That doesn't sound like a lot. It comes every single week. Yes. And lately, it's been a very large market mover. Just know where the announcements are coming, because I don't want you to get caught in the crossfire of a major announcement in some intraday trade and not recognize that the announcement was even coming out. Then you're going to be screaming, what's going on? I'll tell you what's going on. Petroleum report. Okay, moving on to the weekend, initial jobless claims, a little more retail sales, okay, a couple of light bond auctions, yada, 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 and what do we get? Okay, ooh, this could always be exciting over here. Employment, there's nothing really over here but GDP. And GDP should, move markets a bit. And again, that's Friday. Every Friday there's something. GDP is not all that exciting over there, okay, but it's not a week that is filled with announcements over there. Again, I remind you, the markets are at a huge inflection point, and the S&P is right around 1911. Okay, I'm not going to run out and sell premium in the front of the week because I think the implied volatility is a lot lower than it has been lately. I want to see if volatility starts to rear its ugly head. Okay, come Monday, Tuesday, we'll look for some opportunities to be able to sell premium. But at this point, hopefully you've got a couple of positions on. Okay, you're grinding out some time decay in your favor and trying to keep your risk under control. All I would think at this point, okay, this is just a little bit of lull in the market, and that's not unusual. Markets get tired because traders get tired. Okay, we have this explosive rally. We have a little bit of a lull. It wouldn't surprise me at all to see the markets actually reach out to 1950 level and above. Okay, at this point, I still feel there's a bit more upside, but I think we got to go up, in essence, to be able to go back down over here. Enjoy the rest of the weekend here. We know we will here at TheoTrade. If you ever got a question, support at TheoTrade.com. Thanks a lot, everybody. This is Don Kaufman for TheoTrade. Be back on Monday.